Okay, let's unpack this. We are diving into a snapshot of one of the most, well, tumultuous years in recent memory, 2020.
Mm.
This year threw everything at the global economy.
Yeah.
A pandemic-driven recession, market volatility, political turmoil, and widespread social unrest. Our source material is this really comprehensive annual letter from the CEO of one of the world's largest financial institutions reflecting on all that chaos.
Yeah, and what's really interesting about this source is that it goes way beyond just the standard financial report.
Right.
It's a very detailed, quite candid macro diagnosis. It covers, well, everything from their organizational philosophy and internal performance to the, frankly, severe competitive threats facing established finance.
And it ends up with some pretty ambitious public policy recommendations too, doesn't it, for the U.S. economy's future?
Exactly. It truly is a kind of roadmap for how a massive organization like this sees the world.
So our mission today is to extract the key findings in Strategic Outlook. We'll focus on, say, 4 areas: how the bank actually performed during the chaos, this idea of an evolving corporate purpose.
Which is a big theme.
Yeah, definitely. Then the changing, maybe fractured, competitive landscape, and finally their blueprint for long-term American competitiveness.
Mm-hmm.
And here's a truly surprising opening fact that kind of frames the resilience needed. Despite everything happening in 2020, JPM generated record revenue, $122.9 billion.
Record revenue, yeah. And they extended a massive $2.3 trillion in credit and capital. Just huge numbers, even in a normal year.
Wow. So that performance really sets the stage for the first big idea they lay out, doesn't it? This explicit kind of modern shift in corporate purpose.
That's right. For decades, the mantra was primarily maximizing shareholder return. We all know that.
Sure.
Now, the letter really stresses this commitment to serving all stakeholders. Customers, employees, suppliers, communities, and yes, shareholders are still in there too.
And the logic behind it is, well, it makes sense when you think about it.
Mm-hmm.
A successful company has to stay healthy and vibrant, right?
Right.
By excelling for customers, attracting the best talent, investing in its communities. You drop the ball in one area, say, you alienate your customers or your employees leave.
Then it risks the whole thing long term. You can't succeed if one part is failing.
Exactly. It's all interconnected.
And it fundamentally reframes that idea of shareholder value. It makes it really clear that shareholder return isn't or shouldn't be about short-term, sort of rapacious profit-taking. Instead, the letter asserts that great shareholder value is the necessary result, the outcome of building and sustaining a successful, ethically responsible company over the long run. It kind of flips the cause and effect, you see.
That makes sense. But, philosophy is one thing, action is another. How does this translate into actual commitments?
Well, that's where it gets concrete. The scale of the action detailed is pretty striking, particularly around racial equity. There's the $30 billion path forward commitment.
$30 billion. Over 5 years.
Over 5 years, yeah. Specifically designed to address the racial wealth divide for Black and Latinx communities.
Okay, $30 billion is obviously a huge number.
Yeah.
But how does it break down? Is it just a headline figure?
No, they do segment it with specific financial targets. For instance, $8 billion is dedicated to increasing mortgages. The goal is to help an additional 40,000 Black and Latinx families buy homes.
Okay, homeownership focus. What else?
Plus, there's a $350 million commitment aimed at growing Black, Latinx, and women-owned businesses. That's through capital and coaching, things like that.
That $30 billion figure is massive.
Yeah.
But given the sheer scale of the racial wealth gap,
Yeah.
does the letter really detail how something like mortgage assistance alone solves this systemic issue? Or is it more like a statement of intent, a long-term focus?
I think it leans more towards a statement of long-term focus. It asserts that access to capital and homeownership are absolutely essential pillars for building generational wealth.
Right.
But they do couple it with very specific, measurable internal changes, too. It's not just external.
Like what?
Well, beyond community efforts, the letter highlights employee support. And that went far beyond just base pay. They increased wages for thousands of employees, think branch staff, customer service, to between $16 and $20 an hour.
Which is a significant jump for those roles.
Absolutely. And that's supported by an annual benefits package they value at about $13,000 per employee.
And the other thing that really jumped out at me was this commitment to expanding opportunities for people with a criminal background. The whole second chances idea.
Yeah, that was quite something. They reported hiring approximately 2,100 people with a criminal background in 2020 alone.
Wow. What percentage is that of their hires?
It's roughly 10% of their new U.S. hires that year. So it's not insignificant.
Definitely not.
And it's not just a statistic, right? It represents a pretty fundamental shift in how they approach talent sourcing. It shows that this corporate philosophy can actually drive measurable, impactful change in social opportunity.
Okay, so if we zoom out from the internal philosophy to the wider market, what's actually, keeping these big banks up at night? Let's pivot to the competitive landscape. The CEO seems, well, highly concerned.
Oh, definitely. The sources make it really clear banks are playing an increasingly smaller role in the overall financial system. That's the headline.
Smaller role. Why?
Well, the competition is fierce, mainly because it's coming from three powerful directions at once. First, there's the large and frankly powerful shadow banking system.
Firms doing banking stuff without banking rules.
Exactly. Second, you've got the nimble fintech companies, often specializing in just one high-tech function and doing it really well.
Like payments or lending apps.
Precisely. And third, the real behemoths. Big tech. We're talking Amazon, Apple, Facebook, Google, even Walmart moving into finance. They have these massive, ubiquitous platforms and just endless consumer data.
Right, and that leads to this urgency around technology that you hear loud and clear in the letter.
Oh, absolutely. The sources stress that all technology infrastructure must now be built cloud-enabled, period.
Why cloud-enabled specifically?
Because it's necessary to instantly access data, leverage predictive analytics, deploy AI, things you need to do to compete. It's described not just as a good idea, but as absolutely essential. You have to do it to keep up, especially with those big tech giants.
Okay, and this tech race connects directly to another major point in the letter, right? This friction caused by regulation.
Yes, the fundamentally unlevel regulatory playing field. That's a huge theme. Banks face these massive capital and compliance requirements that non-banks will largely avoid.
Can we break that down a bit?
Mhm.
What kind of requirements are we talking about? Because the costs sound enormous.
They are. Banks face higher capital requirements, things like operational risk capital, and then there's resolution planning, like CKR.
CKR, what's that again?
CKR is the Comprehensive Capital Analysis and Review. It's basically the Fed's annual stress test for the biggest banks.
The doomsday test.
Pretty much, yeah. They have to prove they can survive some apocalyptic financial scenario without needing a taxpayer bailout. And that means holding massive reserves, just sitting there.
Got it. And then there are the explicit costs non-banks don't have.
Right. Like FDIC insurance. That cost JPM about $12 billion over a decade. And the Durbin Amendment.
Which limited debit card fees.
Exactly. That cost the bank roughly $17 billion over that same period. Non-banks. They don't face these specific burdens.
So the implication is,
Yeah.
that it pushes business elsewhere.
Profoundly so. This regulatory friction basically incentivizes activity and therefore risk to move into those less regulated shadows.
Okay, so you're moving the risk out of the regulated banking system.
But you're not actually reducing the systemic risk overall. It just pops up somewhere else, somewhere less supervised.
But hold on. Critics would surely argue that those very regulations, those massive costs like CCRR and higher capital, are precisely what made banks strong enough to be part of the solution in 2020, unlike back in 2008. Does the letter grapple with that trade-off?
It does, implicitly. I mean, the letter definitely praises the overall strength of banks going into the crisis. That's clear.
Okay.
But the critique seems focused on overcorrection. Maybe the pendulum swung too far, and they point to evidence suggesting regulatory burden is driving a market shift.
Like what evidence?
Like the dramatic drop in the number of public U.S. companies. It went from about 8,000 back in 1997 to around 6,000 now.
So where are they going?
The suggestion is that capital and companies are increasingly moving to less transparent, less scrutinized private markets, partly to avoid the cost and scrutiny of public listing and heavy regulation.
Interesting. Okay, let's look at how banks actually performed during that initial COVID-19 policy response. The sources praised the Fed and the government for acting boldly and quickly, right? QE, the CARES Act.
Yeah, quantitative easing and that massive $2.2 trillion CARES Act.
Yeah.
The letter credits that swift action with reversing the financial panic really quickly, much faster than during the Great Recession.
And because the banks were in good shape this time?
Exactly. That rapid government response, combined with banks being financially solid, allowed them to be part of the solution immediately. JPM, for instance, funded over 280,000 PPP loans.
PPP, Paycheck Protection Program loans.
Right. Totaling more than $32 billion. That was actually more than any other single lender.
And wasn't there a detail about who got those loans?
Yes, and it's fascinating. Fully half of those PPP loans went to companies with fewer than 5 employees.
Wow. So really hitting the smallest businesses.
It shows how essential the banking system was in just getting that aid out quickly to those who needed it most.
Yet, even with that success, the letter still circles back to this structural critique of regulation, doesn't it?
It does. They argue that post-Dodd-Frank regulations, specifically something called the Liquidity Coverage Ratio Rule, or LCR, has structurally reduced bank lending capacity.
Okay, before we move on, LCR.
Okay.
For those of us not steeped in bank regulation, what exactly does that rule demand? Why would it reduce lending?
So, the LCR rule essentially forces banks to hold a huge amount of high-quality liquid assets, think cash, highly rated government bonds, relative to their potential short-term outflows.
To make sure they can survive a run on the bank.
Exactly. It's a buffer. It definitely makes banks safer, no question. But it also means all those assets held as buffers can't be used for other things, like commercial loans. They're tied up.
I see. And the result of this LCR mandate, according to the letter, is that the U.S. bank loan-to-deposit ratio dropped significantly.
Dramatically. From around 100%, meaning banks loaned out basically every dollar they took in as deposits before 2008, down to about 75% today.
And that 25% difference translates to
Potentially $3 trillion in lost lending capacity over the last decade or so.
$3 trillion.
Yeah. And the letter suggests this forced reduction in credit availability might have significantly contributed to what economists call secular stagnation. That's slower, long-term economic growth we've seen.
So it forces you to weigh financial safety against maybe maximum economic potential.
Precisely. It's a trade-off.
It certainly adds a layer of complexity. Okay, shifting from the last decade's potential stagnation to the immediate future. The economic forecast presented in the sources is, well, incredibly optimistic, almost startlingly so.
Yeah, they talk about a potential U.S. economic boom running maybe even into 2023.
A boom. What's driving that optimism?
Well, it sounds almost too good to be true, but the driving forces they list are powerful and quantifiable. You've got an estimated $2 trillion in excess consumer savings built up during lockdowns.
Right. People weren't spending.
Exactly. Coupled with massive corporate cash balances, around $3 trillion. Then add in the huge projected government deficit spending and QE quantitative easing over 2020 and 2021. That totals something like $6.8 trillion.
Well, that's rocket fuel for an economy.
It really is.
So the sources suggest a Goldilocks scenario, fast growth, but gentle, manageable inflation that's actually possible.
It's definitely presented as possible, yes. But, and this is a big but, this boom scenario comes with a critical risk.
Which is,
It's not primarily about new COVID variants, although that's mentioned. The key financial risk is that the current surge in inflation we're seeing proves to be, well, not temporary.
sticky inflation.
Exactly. If supply chains don't normalize quickly, or if inflation expectations really take hold, the Fed could be forced to raise interest rates sooner and faster than people expect.
And that would slam the brakes on the recovery.
Abruptly slow it down, yes. That's the main downside risk they highlight.
Okay. Shifting now towards the end of the letter, to the leadership imperatives discussed. The sources stress this need for decision makers to always deal with reality. What does that mean in practice for a huge institution like this?
Well, it means institutionalizing preparation for the unexpected. For JPM, that apparently translates into running well over 100 different stress tests every single week.
100 a week?
Yeah. The idea is you can't just prepare for your base case, the expected scenario. You have to constantly look at a broad range of possibilities, even the really improbable ones, to ensure you're resilient no matter what happens.
And the definition of leadership itself needs to evolve, right?
Okay.
Especially in these massive organizations.
Definitely. The letter talks about the leader transitioning away from a sort of command and control style.
To be more like a coach or conductor.
Exactly, a coach and conductor, relying more on what they call soft power, things like trust, maturity, a strong organizational culture to provide clear direction rather than just top-down orders.
Makes sense. And tying back to the tech urgency we discussed, there's a crucial operational lesson in there, too, about avoiding analysis paralysis.
Yes. You have to understand when detailed financial analysis, like doing net present value calculations, is truly necessary, versus when an investment is simply table stakes.
Meaning you just have to do it to stay in the game.
Precisely. Like migrating to the cloud or enabling digital accounts if your competitors are already there.
You don't waste time calculating the ROI, you just execute.
Yeah.
Because it's the cost of entry now.
Exactly right. If you're still debating the ROI of moving to the cloud in today's environment, the letter implies you've basically already lost that competitive race. The focus has to shift entirely to execution speed.
Okay. Finally, let's get to maybe the loftiest section of the letter. This call for a Marshall Plan for America. The CEO argues that U.S. policy failures are a massive, self-inflicted drag on growth.
Yeah, potentially costing the country 1% of GDP growth every single year. That's a powerful accusation.
It really is. And the data used to back it up is pretty alarming.
It is. The letter details some chronic societal failures, like 70% of American youth being ineligible for military service, often due to lack of education or health issues.
70%, wow.
Yeah. Healthcare costs being double those of other developed nations, around $11,000 per person annually. And maybe most depressingly, that statistic that 30% of Americans lack enough savings to cover even a $400 unexpected expense.
Just brutal reality. So what are the proposed solutions? Are they just aspirational?
No, they're framed as practical action steps. The first one involves job training. They advocate strongly for skills-based training, maybe modeled after successful German apprenticeship programs,
Right.
and a pretty dramatic reform of hiring practices.
How so?
Well, the critique is that requiring a 4-year degree for what, 74% of new jobs, effectively excludes 2/3 of American workers who could potentially fill those roles if hiring focused more on actual skills and capabilities.
Less credentialism, more capability.
That's the argument. Emphasize capability over credential.
Okay, what's the second major step?
That focuses on affordable housing and mortgage rules. The letter argues that the regulatory reaction after the subprime crisis, while well-intentioned, was an overreaction that became costly and actually hampered growth.
An overreaction. In what way?
Well, their analysis suggests that reforming the mortgage system responsibly, of course, to increase access and correct that pendulum swing, could unlock over $1 trillion in additional loans over 5 years.
$1 trillion in loans, mostly for whom?
Predominantly for lower-income households. So it directly addresses that systemic failure to provide capital for building core wealth, like homeownership.
So these policy ideas, training, housing, healthcare, they all feed into this ultimate goal.
Right. Maximizing healthy fiscal growth. The CEO posits that if the U.S. had managed to grow at 3% instead of the 2% average over the last decade,
which is a big difference over time.
a huge difference, it would have created an additional $2.3 trillion in GDP.
Wow.
And that kind of sustained growth, they argue, provides the only truly sustainable resources needed to counteract inequality and tackle the very social problems that financial institutions themselves are now committing billions, like that $30 billion path forward, to try and fix. It links national policy right back to their own corporate purpose.
So to wrap up this deep dive then, the key lesson, it seems, distilled from these sources, is this massive complexity facing the financial sector. It's not just the fierce external competition from big tech and shadow banking.
No, it's more than that.
It's simultaneously navigating this incredibly complex, maybe arguably inefficient regulatory environment, while also trying to address these deep, chronic societal failures in health, education, housing that ultimately threaten long-term American economic growth itself.
And if you connect that critique to the bigger geopolitical picture, the letter really frames American policy failure as the only real threat to its global preeminence.
Not external rivals.
Well, while China is obviously a rising power, the sources point out its own significant, potentially insurmountable weaknesses, its autocratic governance structure, looming demographic issues.
Right.
The argument is the U.S.'s biggest threat is internal. It needs to reassert confidence in democracy by proving it can actually function effectively and competently address its own self-inflicted wounds.
Which leaves us with a really crucial, lingering question for you, the listener, to mull over. Think about this. After the Great Recession, we saw $3.4 trillion in quantitative easing. But it didn't lead to runaway inflation, partly, as argued here, because new regulations like LCR reduced bank lending capacity, that $3 trillion in lost loans.
Yeah. A regulatory break.
Right. Now, fast forward to the COVID-19 response. The QE and fiscal deficits are exponentially larger this time around. And crucially, consumer and corporate balance sheets are much, much healthier than they were back in 2009. So the question is, does that regulatory system still act as a sufficient brake on lending and inflation? Or, given the sheer scale of stimulus and healthier starting point, is an inevitable and potentially dramatic surge in inflation and interest rates simply a matter of time?